watching The Money Show on ET Now. We just spoke about paying your advance tax, we spoke about filing your income tax return, but here's a step that you need to take, another one in fact apart from paying your advance tax for FY21, and that is making the right tax saving investments. I know it seems like the year literally has just started, but this financial year has in fact just got 3 months to end. Before the 31st of March, you need to make certain tax-saving investments. Now, here's one tax-saving investment option, ELSS. The Tata India Tax Saving Fund, as the name suggests, is one tax-saving investment option for all individuals. In fact, you can invest up to 1.5 lakh rupees and you can enjoy a tax break of that much amount. So we decided to talk about this fund a little more in today's episode of our Meet Your Fund Manager segment. Rupesh Patel, Senior Fund Manager of Tata Mutual Fund, now joins us on the show. He also in fact manages the Tata India Tax Savings Fund. Rupesh, thank you so much for joining us today on ET Now. To start with, Rupesh, what makes a mutual fund eligible for it to get this sort of tax break, or for it to offer its unit holders this kind of a tax break?
Yeah, thank you. Thank you so much for having me on the show. So I think if we look at ELSS funds, investors typically tend to look at ELSS funds as just one more avenue to save taxes. Whereas I strongly believe that there is much more to it than just an avenue to save taxes. And for that, we have to look at features of ELSS funds. The first and foremost important feature is the 3-year lock-in. I think investors, particularly in volatile times like this, tend to ignore the importance of this 3-year lock-in. And many investors actually tend to look at it negatively. But look at a situation like we had in March 2020 when markets were volatile. We saw such a sharp correction. And there were all sorts of predictions on how low markets will go. And in such a time, it was very natural for anyone to panic. And I mean, if one would have panicked because and would have taken the investments out of markets, then he would not have benefited from the up move which came. And we saw markets not only recovered from that correction, but markets are today at an all-time high. So only those who could have remained invested in the market benefited from it. So I think in that sense, this 3-year lock-in is something which actually works in the interest of investors. So whilst investing in ELSS funds, investors, 3 years is the minimum lock-in, but I would suggest that a longer investment horizon would really help investors. And not only that, but this 3-year lock-in really helps the investors in remaining invested. So one should look at these funds as a fund which becomes an open-ended equity fund after 3 years of completion. Second important aspect which I would like to highlight is the amount of investment which you can do. Though the tax benefit is today restricted to 1,50,000 rupees, which an investor makes and gets tax benefit on it, but there is absolutely no restriction on maximum amount which you can invest in an ELSS funds. So, I mean, your investments doesn't really get restricted by the extent of tax benefit which is available. And third thing is that by nature, ELSS funds are go anywhere fund. There are absolutely no restrictions in terms of market capitalization or in terms of sectors where they can invest or they cannot invest. So a fund which can invest across market capitalization depending upon market opportunity has no sectoral biases. I think are or can be seen as an ideal vehicle for accumulation phases in an investor's life. So I believe that because of these 3 reasons which I explained, ELSS can be a very healthy or can be a really attractive investment vehicle to accumulate wealth over a longer period of time for an investor.
Okay, so I suppose the 3-year lock-in really essentially forces the investor, to stay invested for a bit of a more longer term, perhaps in a way ensures discipline, because like we always say, when you invest in equity mutual funds, you should do so for the long term. And I think the intention of the ELSS as well is the same, to ensure that the investor is investing in the fund for the long term. So, Rupesh, you mentioned that there's a flexibility of sorts in the fund to invest anywhere across market capitalization. So tell us about the Tata India Tax Saving Fund. Where do you invest? How do you sort of decide, where to invest with the fund?
So when you look at the investment philosophy of Tata India Tax Savings Fund, our approach is, as we preach our investors that, don't think short term, and when you invest in equities, it's for long term. We follow the same philosophy whilst managing our own funds. So when it comes to Tata India Tax Savings Fund, the core of the portfolio generally comprises of companies which have long runway for growth, which can compound at sustainably healthy rate over a longer period of time. Because we have seen that in market, such companies, if they can compound over a longer period of time, they tend to be the biggest wealth creators. So the idea is that if you get a company like that, where you can foresee that the runway for growth is long, management is decent, ROE, ROCs are not a concern, and you can see that earnings can compound at a certain healthy rate over a longer period of time. If you get PE re-rating in such cases, which typically happens, it's icing on the cake. So look at constructing the core of your portfolio around such types of companies. But at the same time, be open to opportunities which markets throw many a times, mispriced opportunities because of market-related developments, because of industry-related developments, or many a times because of company-related developments, where you can very clearly see that, what market perceives and what reality is, there is a mismatch, and because of that reason, there is mispricing in the market. So be open to such opportunities, and tactically one can look at allocating to such opportunities which markets typically give, particularly when they are volatile. Only difference is that when you invest in such kind of opportunities, your investment horizons can be very short. It can be just to the extent of exploiting the mispricing in the market, or it can be slightly longer period wherein it takes some time before the market's perception of risk changes, and we start seeing that the mispricing corrects itself over a period of time. So this is broadly, these are two broad sets out of which we construct our portfolio. And we, as I mentioned in my initial comments, that our thought process is not colored by the market capitalization or by liking or disliking for a particular sector. I think this approach, so in that sense, our approach is truly market cap agnostic, truly sector agnostic, and it's something which has helped us over a longer period of time in terms of our performance as well.
Rupesh, how would you compare this fund with, say, a Tata's PE fund, which is the value fund, or maybe a Tata large cap fund? In terms of the risk factor is what I want to understand. For our viewers as well to decide based on their own risk appetite. Every individual would have a different risk appetite. Some may not be comfortable taking on too much risk, even if they may be having the capacity to do so. So if you could just talk to us about the risk factor.
I think it would not be appropriate to compare this fund with funds which have either a style constraint or a fund which has a market cap constraint. So when we talk of large cap, by definition, at least 80% of portfolio at any point in time has to be in top 100 stocks as defined by MFI, a list which gets revised every 6 months. According to current SEBI regulations. So your 80% of portfolio has to be constructed out of these 100 stocks. Remaining 20 stocks where fund manager has discretion that he can go out of these top 100 stocks, and if wants to buy a stock from a mid cap or a small cap category, can do that. So the proportion of large cap would vary between 80% to 100% in the large cap portfolio. Whereas in tax fund, as I mentioned, it's a completely market cap agnostic fund. So if I talk about our own fund then and look at last 5 years history, the proportion of large cap has varied between anywhere between 50 to 53%. It has gone as high as 85-86%, depending upon where opportunities have been there in the market. Whereas a large cap fund, by definition, has to have minimum 80% exposure to large caps at all point in time. Similarly, we can't compare it to a style constrained fund like a PE fund, as you rightly pointed out, it's a value-oriented fund wherein minimum 70% of investments have to be in stocks which have PE less than the index PE. So in that sense, it puts a style constraint on the fund, and there are no such constraints in case of a Tata or in case of a tax saving fund, where you can invest in low PE stocks, high PE stocks, or you can look at high growth stocks, you can look at really value stocks. So in that sense, there is again no constraint in terms of style. So I believe that it's not appropriate to really compare these funds with a tax saving fund.
No, of course, understandably, everyone's style is essentially different. The investment strategy as well is different. So completely understandable. But just the idea was to get a sense of a riskometer, if you could call it that. I know SEBI is going to any which ways disclose riskometers of all of these funds individually, just sort of getting it a bit in advance.
So if I have to answer,
I think we are out of time. So Rupesh, we'll wrap it up. Many thanks. Sure, go ahead. Complete your point.
Yeah, so if I have to put it in one line, it's like large caps, because they are generally less volatile, would rank lower in terms of risk vis-a-vis a fund which can invest across large cap, mid cap and small cap, and can have much higher mid cap, small cap allocations. So between the two, that's how I would put them.
Okay, understood. Well, Rupesh, we're completely out of time. So for now, we'll have to wrap it up. Many thanks for joining us today on ET Now and on The Money Show.
Thank you so much for having me.
And folks, if you would like to catch this conversation, you can log on to ET Now's YouTube channel and, find The Money Show playlist. For now, we'll take a very short break on the show. Don't go anywhere.